Look at the markets today. You see the headlines, you see these massive price movements. And honestly, it's incredibly easy to get swept up in the frenzy. But the key question is not how much gold has risen, but whether investors are buying gold out of expectation, fear, or the need to preserve purchasing power. If you can answer that, you can completely cut through the noise.
Welcome to this explainer. Today, we are putting on our CFA hats. We're stepping completely away from the panic and the FOMO, and we're looking strictly at the actual data driving the 2026 gold market. We're going to break down the global macroeconomic drivers, and then we'll build a localized 6 to 12-month strategy specifically tailored for Vietnamese investors.
Here is our roadmap. We are covering the role of gold, the macro paradox, the Vietnam premium, your investment strategy, the risks you need to avoid, and finally, a core summary. Let's get right into it.
Let's kick things off with Section 1, the role of gold. We really need to redefine what it actually does in a mature portfolio. What's truly crucial to understand right out of the gates is what gold does not do. Gold doesn't generate cash flow, it doesn't pay a dividend, and it doesn't pay interest. Think of it strictly as a safe haven asset. It's a defensive tool, an insurance policy designed to protect your purchasing power and defend against systemic risks when trust in fiat currency starts to weaken. It is absolutely not a speculative instrument for getting rich quick. Just look at the historical track record. Across massive market shocks, whether it's the 1970s oil crisis or the 2008 financial meltdown, gold has consistently done its job. When inflation runs hot, especially when it crosses over 5% annually, or when severe stress hits the traditional financial system, gold preserves wealth. That is its fundamental purpose.
Okay, moving on to Section 2, the macro paradox.
Here's where things get really interesting in 2026 because the global macro environment is totally ignoring traditional financial models. Usually, rising real interest rates like a 10-year Treasury yield pushing 4.5% and a strong US dollar index absolutely crush gold. The opportunity cost of holding a non-yielding asset is supposed to be way too high. But right now, gold is just defying gravity. Why? Because those classic headwinds are being completely bulldozed by massive tailwinds, relentless central bank buying, deep fears of stagflation, and severe geopolitical fragmentation.
You really have to understand the specific environment we're operating in right now. We are looking at a classic stagflation-light scenario. U.S. first-quarter GDP growth slowed to a crawl at 2.0%, but April CPI inflation remained stubbornly high at 3.8%. Meanwhile, the Federal Reserve is holding rates between 3.5% and 3.75%. Economic growth is slowing down, but inflation won't quit. This completely boxes the Fed in. They can't easily cut rates without reigniting inflation, and they can't hike them without tanking growth. And then there's this number, 244 tons. Let that sink in. That is the immense volume of net physical gold purchased by global central banks in just the first quarter of 2026 alone. This proves that the really big money is acting on deep structural shifts, not just trading off short-term news. Even with prices near record highs, massive institutions like the People's Bank of China and the National Bank of Poland are aggressively scooping up gold.
So why are they buying like there's no tomorrow? Two words: de-dollarization and fiscal deficits. With U.S. public debt expanding immensely and currencies increasingly being weaponized as a geopolitical tactic, emerging market central banks are making a massive structural shift. They are aggressively substituting their fiat reserves, specifically U.S. dollars, with physical gold. They are buying systemic insurance.
All right, Section 3, the Vietnam premium. Let's bring this global macro picture down to the highly localized reality of the Vietnamese market.
If you're investing in Vietnam, you're playing by a completely different set of rules. We are looking at a massive valuation disconnect. You have the global spot price setting the baseline, sure, but the domestic SJC price frequently trades at a wildly irrational premium. We're talking about a significant gap where local investors are paying drastically more per ounce than the international market actually dictates. Why does this crazy premium even exist? It's rooted in very specific local drivers. First, you have a heavily constrained domestic supply mixed with strict state-managed SJC gold policies. Throw extreme investor psychology into that pressure cooker and boom. When global prices spike, local retail panic sets in. It drives up localized safe haven demand, and people completely rush in and overpay purely out of the fear of missing out.
Section 4, investment strategy. How should a Vietnamese investor actually navigate this complex minefield over the next 6 to 12 months?
It requires absolute discipline. Step 1, do not go all in, and whatever you do, do not succumb to FOMO. Step 2, implement a gradual accumulation plan. Wait for those inevitable global spot corrections, like when the dollar spikes or yields jump temporarily, to slowly build your position. Step 3, remember the definition we talked about earlier. Use gold strictly as a defensive portfolio allocation. Keep it to a mid-single-digit percentage to balance your equities and cash. It is your insurance policy, not your primary growth engine.
Section 5, risks to avoid. Because to pull off that strategy, you have to sidestep some massive landmines. I literally cannot stress this enough. Buying when that SJC premium is at its peak is a guaranteed way to destroy your wealth. You're instantly putting yourself at a severe disadvantage. Stay far away from chasing sharp, vertical rallies, and absolutely never, ever use margin debt or leverage to buy physical gold. You also have to be mentally prepared for short-term corrections. If the Fed stays hawkish, keeping the US dollar strong and Treasury yields high, gold is going to face serious downward pressure.
Finally, Section 6, Core Summary. Let's pull all of this data and strategy together.
Consider this your macro dashboard for the next year. Keep your eyes locked on 5 key factors: real interest rates, the USD index, Treasury yields, Fed policy, and crucially, that Vietnam global gold premium. Be hyper-aware of the 3 biggest wealth destroyers: FOMO, leverage, and unexpected hawkishness from the Fed, and anchor your strategy to 3 core insights: stay defensive, accumulate gradually on the dips, and always focus on protecting your purchasing power. I'm going to leave you with this final, vital thought. Gold is not an asset for getting rich quickly. Gold is an asset for protecting purchasing power, defending against risk, and balancing a portfolio when trust in money is being tested. Big money does not move before the news. It moves before expectations. The central banks are acting on long-term expectations, and you should too. Ask yourself, is your portfolio actually built to withstand the next shift in global trust? Follow and subscribe to LIMT. Quote Lai Độc Tu to understand the real story behind numbers, policies, and capital flows. Stay focused out there, and I will see you in the next explainer.